Good morning and welcome to this Wednesday, July 6th, 2022 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we had a nice day on Tuesday, coming off the long holiday weekend. We started off not so great with some red futures, got off to a little bit of a rough start, but then saw buying pick up early in the morning and buying continued throughout much of the day. A huge drop on the Dow Jones was mostly erased. I think we were down over 700 points early in the morning, came back pretty close to that break-even point. Let's see, where did we finish yesterday on the Dow? Down about 130 points. The S&P, though, went green. The NASDAQ went green. The VIX, after shooting higher earlier in the day, came down, was still up for the day about 3%, but the VIX is down in the 27s, which is much better than the 36s, which is where it had been. So overall, I thought the action was pretty good. We've seen crude oil prices dropping dramatically. The 10-year Treasury yield certainly doesn't look like folks are getting out of bonds because of inflation any longer. Got a lot of folks jumping into bonds, sending the yields down. This morning, they were down again, down another 4 basis points, 2.77%. And it was mid-June, we were at 3.48%. So, I mean, that's 71 basis points. That's a lot of movement. Notice not seeing a whole lot of articles and talk about the yield coming back down, not like when it was going up. You know, good news doesn't sell. We got to stick with the bad news. So we move on to the recession talk. And what's going to be really interesting is the recession talk is going to start to put pressure on the Fed to slow down those rate hikes. And I think by the end of the year, recession talk is going to turn to deflation talk. And the Fed's going to be full on dovish mode by later this year and early into 2023. That's my prediction. And as a result, we're seeing money rotating into growth stocks. I got some interesting charts I'll show you a little bit later in the 3 you must see. But I'm seeing some pretty exciting rotation into growth stocks, some of the small and medium cap, mid cap growth stocks. And I think that can really bode well for the market as we move throughout the rest of the summer and into the fall, especially. Currently, let's see, futures have been mostly lower, just slightly lower now. We've got, I'm looking at the spider on stock charts in the pre-market down 24 cents to 381.72. That's 0.06%, pretty small. The, let's see, the NASDAQ, pretty much flat. So we've seen the NASDAQ come back. I'm showing now up 4 cents on the QQQ. And the diamonds are down about 0.09%, down 29 cents to 309.42. So once again, it looks like money was, the NASDAQ actually was down more than the spider and the Dow earlier, but looks like that's reversed. And that was a big theme yesterday. The NASDAQ actually did very well yesterday. Even though we saw the Dow down 130 at the close, the NASDAQ was up almost 200. So on a percentage basis, NASDAQ did extremely well, and we're seeing that rotation back to growth. Now, when I think of NASDAQ, I think growth. When I think of S&P 500, I think of value. And maybe even the Dow, maybe even more value. But, you know, each one of those indexes, from the Dow to the S&P, the NASDAQ, and then maybe even to the smaller cap names, it's just riskier and riskier as you go, more and more growth names. So when you start thinking about recession, naturally you say, well, these stocks can't do well, these growth stocks, not in a recessionary environment. Well, it's priced in. I think we're in a recession. I think last quarter we had a negative GDP reading. End of this month, we get the next one. If this one's negative, guess what? We have a recession. I kind of chuckle sometimes because I'm looking at all these folks saying, well, we might have a recession next year. It's like, what about right now? We just had a negative GDP. The latest, the final Q1 GDP, they've revised it even lower. I think it was expected to come in minus 1.4%. It was minus 1.6. So it seems to me like it's heading the wrong way. All it takes is one more negative reading, and you've got the recession, which is defined as 2 negative quarters in a row. So I don't know why everyone's looking at next year. I've been seeing it, talking about it this year for months now. I don't remember if I talked about recession and everything last year. It was a long time ago, though, that I started talking about recession. Those of you that are EarningsBeats members know I've been talking about recession, inflation, then it was going to be recession. Well, I'm telling you now, it's going to be deflation later. That's going to be the next fear. Everyone's going to be worried about deflation. That's because supply is going to catch up. And with a recession, demand goes down. We flip the inflation table. All right, let me go ahead and take you all over. Sorry, I haven't given you your screen yet. But let me. All right, you should have your screen up now. Over to EarningsBeats.com. For those of you that are new to Trading Places Live and new to EarningsBeats, follow my blogs. Come over to EarningsBeats, scroll down, sign up for our free EB Digest newsletter. This is a great way to get to know us and the way we look at the market. I don't know how many folks out there called the top back on December 31st and early January. I'm in print. I'm in on, recordings. Talked about it back then. Got a lot of criticism back in June for calling what I thought was a market bottom. We'll see what happens. You never know. I mean, we're only a couple hundred points on the S&P 500 off the bottom, so anything can happen. But I'm telling you, I'm seeing a lot of rotation right now. It doesn't look like we're going back down. So could have had another very timely call. But if you want to learn more about how we look at the market, because it's not just about looking at the charts of the S&P 500 or of the semiconductors, there's a lot that goes behind it, a lot that you need to be aware of. You don't need analysts, you don't need CNBC, you don't need any of those things. You need the charts, and you just need to learn a little bit about the key ratios and key things to watch in the market. That will change your life forever in terms of the stock market. But anyway, check out my blogs over at Stock Charts. Also, if you go to earningsbeats.com and scroll down, we've got a free newsletter, name and email address, all it takes. No credit card required. You don't have to, worry about giving someone your credit card. You become, more familiar with us. You trust us. You want to become a member. Then you can do that. For this, you don't need a credit card. You can unsubscribe at any time. Comes out 3 times a week, so it's fairly frequent, but it's an easy, quick read. Mondays, Wednesdays, Fridays, we try to get it out to you by about 8:30 in the morning, about an hour before the market opens. Sometimes I run a little bit late, so maybe it's a little later occasionally, but I do try to get it out with help of Aaron at EarningsBeats. We try to get that out by 8:30 in the morning Eastern. But it talks about earnings and relative strength and gaps and candlesticks and volume and trend lines and intermarket relationships and all these things that mean a lot to us as, when we look at the market. So make sure you check that out. Go over to EarningsBeats, scroll down and subscribe to our free EB Digest newsletter. All right, so let's move on. What the heck happened on Tuesday? Well, we started off not so good, but we did rally back. The Dow Jones, if you just, at the end of the day, hadn't seen anything all day long, you might have thought, well, it wasn't a great day. The Dow was down 129. That really wasn't the story. The story was the Dow was down more than 700, and it rallied back and got back almost all of those points by the close. The S&P, which was down significantly intraday, came back, finished positive, up 6 points. The NASDAQ really was the leader in terms of relative strength. I mean, it wasn't even close. Certainly a bifurcated market with a lot of money pouring into those growth-oriented NASDAQ stocks. But the NASDAQ finished up almost 2%, 1.75% up 194 points. Mid caps and small caps kind of straddled the break-even point. Mid caps down 3 points, small caps up 1.5, and they too were down quite a bit earlier and rallied back. As far as sectors go, 8 out of 11 sectors were down. Again, that might not sound great, but the 3 that were up: communication services, discretionary, technology. I mean, if you're, in the bullish camp, or you're, following the market and you're wondering what's bullish, when these three amigos right here, communication services, discretionary, and technology, are getting the love while everything else is down, that just reeks of rotation into bullish areas of the market. So you might look at the Dow and say, well, we're down 129 points, not a good day. That's not true. You got to look at the rotation that's taking place in the market. This is really bullish. And I'll just mention XLC, lower lows, higher PPO. XLY, lower lows, higher PPO. XLK, lower lows, higher PPO. Positive divergences on the three key sectors. Again, this doesn't mean that the selling is over. When I see a positive divergence, I look for the PPO to go back to the center line and or price to get back to the 50-day for a reset. And then we evaluate what happens from there. But we've still got room just to get the reset. And then, like I said, we'll see what happens from there. I think if rates keep coming down, the market turns its attention away from inflation. I don't think these growth stocks are going to stop at the 50-day moving average. I think we caught the bottom, and I think these growth stocks are going to continue to move higher. So keep an eye on that. Meanwhile, I was talking about energy when it was bouncing. I said, watch out. This could be a head and shoulder top. Don't like energy. I said earlier in the year, we could probably do okay with energy. I liked energy for the first part of the year, but at some point, I figured inflation was going to be done. And when inflation's done and oil prices start dropping, energy's done. And I think that's where we are right now with energy. I think we're done. Could we bounce to the 20-day? Sure. I mean, we've been down quite a bit on these other sectors, and they've bounced from time to time, but the overall trend has been down. I think the overall trend in energy at this point is down, and until proven otherwise, I would be selling energy on bounces, getting out, moving into more growth-oriented areas. That would be my suggestion. Do it, whatever you feel is comfortable to you, but I'm not liking the way I see energy right now. Utilities, I'm not a fan. Even though with yields coming down, utilities will look stronger. I just think the rotation away from defense to offense is going to put pressure on utilities to some degree. So anyway, those two were weak yesterday, the weakest of the 8 that were down. 10-year Treasury yield. Well, first, we do have some economic reports coming out later this week, some pretty big ones. For today, June PMI composites coming out at 9:45, 51.6 is the estimate there. June ISM services will be out at 10 a.m. May was 55.9. We're actually expecting a drop here to 54.8 for June. We'll see what happens there. And then watch out at 2 o'clock. We could see some volatility because the FOMC minutes come out. So the minutes of the last Fed meeting will be out at 2 p.m. talking, showing all the things they talked about. I'm sure they're going to talk, there's going to be discussion about inflation, blah, blah, blah. That's old news. I'm looking at the 10-year Treasury yield right now. Let's get an update and see where we are. 277 right now, still down almost 4 basis points. Been down in a straight line. I've said if we lose this 268, 270 area right in here, I think that the market has spoken. I think the bond market has spoken and no longer sees inflation as a threat. I'm seeing it already. I believe that, but I may have had some bias going in. So it's always nice to see the bond market start to confirm my bias. And I think that's what we've been seeing over the last few weeks. Later out this week, tomorrow, because Monday was a holiday, the ADP employment report got pushed back a day. Normally comes out on Wednesdays, but it's coming out on Thursday this week. So tomorrow we've got the June ADP employment, also initial jobless claims, and then on Friday, the big June non-farm payrolls. Last time I looked, the expectation for June was 270,000. May was 390,000. So it's showing a slowing, potentially a slowing environment there. I wouldn't be surprised if we come up short of the 270. And I actually think it would be good for the market if we're positive, but maybe short of 270. Anything above 270 in the market might think, oh, well, things are still hot. And so therefore want to be careful with inflation. I think the number's a little below 270. We still got probably a pretty soft landing in terms of the economy, in terms of a recession. I believe it's going to be a mild one. But I want it to at least be positive. I think if it's a huge drop, a sudden drop, then I think it could be giving off signals that maybe the recession could be deeper than maybe folks are thinking. And then that could maybe in the short term take the market down just because it wasn't pricing in quite that deep of a recession. But we'll see how it comes out. I'd really, like I said, I'd just like to see that number on Friday come in positive, but less than the 270. 200, 250 would be great. 150 be fine. I think if you start getting much, much lower than that, it could spook the market a little bit in the short term. Again, market prices in recessions, the Fed's got plenty of ammunition to help with the recession at this point. I mean, rates now have been jumped quite a bit. So they got some things tucked away, for a recession. I'm not too worried about that. Once the Fed turns dovish, I think you'll see the market going up. All right. Anyway, that's the 10-year Treasury yield. Some of the economic reports due out. S&P 500, there's that recovery I was talking about. It was down at this low, threatening the low that we saw back on Thursday of last week before rallying back up again. Notice we're getting a lot of these hollow candles where we're closing pretty strongly at the end of the day. With the exception of this one big red candle last Tuesday, everything else has been, I would say over the last 2 weeks, fairly bullish in terms of hollow candlesticks, closing more towards the high than the low, that sort of thing. So I'm liking what I'm seeing on the S&P. Couple of industry group charts I wanted to show you. Internet stocks, I think this group is really starting to look good. And not because of great action. I mean, yesterday was super, it was up 4.5%, but you can see it's still in a downtrend and all. But when I start seeing this, lower prices, and this higher PPO. I mean, we saw it right here in March, and we saw that, and you can see the move we made coming out of there. So that it worked, but again, we got a reset, and then the market rolled back over. The thing is now we're getting market rotation that we didn't have back then. And that's what I was stressing throughout 2022. Every time we hit one of these lows and bounced, you can go back and look at our daily market reports. Every one of these bounces, I said, I think we're going back to new lows. I mean, it's nice to get these bounces, but I'm not seeing anything that is starting to suggest that the bottom is in. Well, in June, I said I thought the bottom was in. Now we're getting positive divergences with signals, other corroborating signals that the market looks good. Remember, our 5-day moving average of the equity-only put-call ratio hit 0.80. That is a level that has seen major bottoms come in the past. We didn't get that until this low in June. So now I'm looking at the market with more bullish information with a more bullish background and backdrop and environment. I'm seeing more bullish signs. So now when I see this positive divergence, I'm thinking, okay, 50-day test, but I wouldn't be surprised if we just go right on through. Just like that old, was it the Doors song, break on through to the other side? That's what it's looking like to me. All right. Looking at the broadcasting and entertainment. I mean, those of you probably getting sick of Disney, if you've owned Disney for a while, I think things could be turning here. Again, look at the lows there. Look at the higher low on the PPO. I think not only do we get to the 50, I think the bottom's in. I think we're, maybe, we got summertime. So I'm trying to consider all the possibilities, and summertime tends to be slower than usual. Maybe we just sideways consolidate for a while. Maybe we go up, we set a top somewhere, and then over the summer kind of go back and forth. Or maybe we just go higher. I mean, it's not like the summertime you can't go higher. It's just that the tendency, there's more of a tendency to struggle in the summer. But there have been plenty of summers that have seen prices go up. So don't think it can't happen. It absolutely could happen. But whether we go up over the summer or not, I believe we're looking forward to a big fourth quarter. I don't care if we go up. If we go up, I think it's just going to go up even more. If we don't go up, I think we explode in the fourth quarter. Either way, I see prices going up. That's just my take. My opinion. Everybody's entitled to theirs. Mine's just one opinion. Let's move on. Seasonality. And for those of you with EarningsBeats, I am going to try to get a seasonality report out to everybody later today. That's the goal. I do think now that we're starting to turn the corner and we're starting to become more bullish, I think some of these seasonality patterns can really help us, give us more information. One that I wanted to just show you today is Apple. You may not realize it, but first of all, this secular bull market began in 2013. A lot of people point to the 2009 low and say that's when the bull market began. Well, you don't know that it began there. When you know it begins is when you take out the prior highs, which occurred in 2013. That's when we took out the 2000 and 2007 S&P 500 highs. Anyway, since that time, 2013 till now, the last 10 years, Apple relative to the S&P 500. So I'm looking at the relative strength of Apple. I want you to look at these 2 months, July and August, because these are by far the best 2 back-to-back months for Apple relative to the S&P 500. And this is coming in at a time when I think the market's bottoming and we're shifting back to growth. So this is good information to know. Apple, 80% of July, so 8 of the last 10, Apple has outperformed in July. And 8 of the last 9, of course, August, we haven't had yet in 2022. So going back to 2013, they're 9 years. 8 of the 9, Apple has outperformed. So 8 out of 10 in July, 8 out of 9 in August. And look at the average outperformance per month. Just these 2 months alone, Apple averages outperforming the S&P 500 by 10 percentage points. So if the S&P, normally in July and August, we see the S&P go down maybe 1%. That means Apple average is going up 9%. Just looking at it and simplifying it based on these numbers. So yeah, it's pretty important, I think, that you understand that Apple is seasonally one of the stronger stocks. Now, when we began July, here we're at 137, and we've seen July start off already a couple pretty decent up days, but this is just a start. Next couple months, we tend to see outperformance. I'll also mention lower prices here on Apple, higher PPO. We have a positive divergence. So that tells me 50-day is what I should be looking for at a minimum. So that's 146. That's another $4.50 from here. But ultimately, like I said, I think these positive divergences lead to breakouts above the 50-day. So Apple to me looks pretty interesting. And I like Apple. I would have no problems owning Apple at this point. And I talked about Apple back at the beginning of the year. Remember, I made that wild prediction about Apple when it was at 180. And I said, I wouldn't be surprised if it goes, I don't remember if in the article I said 140, and I said it's even possible we could get the 120. Well, that was back beginning of the year. We got down into the 120s. I think this is fine. I think Apple is a great buy now. No problem owning Apple. We moved it a couple of weeks ago into our income portfolio just because it does pay a dividend. So it's a little bit of a, I'm not going to say value stock. I don't think Apple's a value stock. I think it's growth, but there's maybe an element of value just because it does pay a dividend. All right, let's talk a little bit. This getting back now to the EarningsBeats.com mailbag. I've had questions in the past come up asking me to talk about the inverted yield curve and, you know, the impact, because that's in the news now. Now everywhere you're reading, everybody's talking about recession. You know, inflation, we can't talk about that much anymore because interest rates coming back down. What are we going to write about, everybody? Recession. We got an inverted yield curve. Recession's the big one now. So just get ready for it. You know, it's already started. If you haven't seen it, it's coming to a theater near you. And it really is like a theater because to me, it's entertainment, pure entertainment value. By the time a yield curve gets inverted, if there's a recession involved or potentially involved, the market's already priced it in. You know, media is acting like they're providing you some kind of great news. I try not to get started on them. Drives me crazy. And I'll tell you, the reason it drives me crazy is because there are so many people that listen to this and then make investment decisions. That's why it drives me crazy. They're not trying to educate anyone. They're trying to get clicks. Who cares if somebody loses 10% of their or 20% of their retirement? I just need that click. Anyway. All right, deep breath. So this is a chart at the top here of the 10-year treasury minus the 2-year treasury. To me, there's two rules of thought about looking at the spread between, and the yield curve. The spread, I like, well, I look at both of them. One, the 10-year versus the 2-year. I think that's the more common benchmark that folks use in terms of determining the yield, the yield spread or the yield curve. I like to also look at the 10-year treasury versus the 1-month treasury bill, because to me, the 1-month treasury bill is really the short end of the curve, and the 10 years more the long end. So, but I'm going to show you both of them. You can make your own mind up. This is a 20-year chart of the 10-year minus the 2-year. So all this is doing is just tracking the difference between those two treasury yields, the 10-year and the 2-year. And when it goes below 0, you have an inverted yield curve. So here's 2006, beginning of 2006 and into 2007, inverted yield curve. Of course, remember what happened, the financial crisis. So it's worth paying attention to. 2019, we went negative. And of course, we had the pandemic and then went almost negative with the pandemic. And then the market soared. And that, confounded everybody who was talking about the yield curve. Yield curve doesn't work all the time. There's a lot of other factors. It's one piece of the economic puzzle. Just like, the PPO is one piece of the technical puzzle. I don't make all of my decisions based on the PPO. I don't make all of my decisions based on the yield curve. It's one signal. Anyway, it has gone back to that 0 line right now. And so it's worth paying attention to. Here's the bank index throughout this 20-year period. And then this is the correlation between the direction of the yield spread or curve and the direction of banks relative to the S&P 500. So in other words, when the yield curve's going, or when this spread's going up, banks here are going down, you go down into negative correlation. When we're going down like in here, and then we go down here, you'll see this move into positive territory. So this is just a cumulative 20 period, and it's a weekly chart. So it's looking at a 20-week period and looking at how they move over a 20-week period. And I would say that the tendency is pretty positive. We tend to see, if the yield spread is dropping, we tend to see banks underperform. When the yield spread's going up, we tend to see banks outperform. That's what this is telling us. Back during, the secular bear market, it was a little bit more 50-50, I would say. But throughout this bull market, it's been pretty strong in terms of correlation, positive correlation, much more positive correlation. Very rarely do we see a lot of negative correlation or inverse correlation. So we want to watch it, because if you're interested in investing in banks, this is kind of a big deal. It's going down. Probably not a great time to be in banks unless you think we're bottoming, because once this starts to go back up again, you'll want to be in banks. That's what history tells us. Now, the next one is the 10-year treasury minus the 1-month treasury. Now look at this one. It's been coming down, but it still shows a much brighter picture. And when I look at it, I'm not so sure this one isn't even better. I mean, it's got a little bit more of a negative correlation right now, but if we're looking at the history, I think this one might be even more strongly positively correlated. Very, very few trips into inverse correlation. Here, look at all these different times we went negative. What it's telling me is that the 10-year minus the 2-year isn't as positively correlated as the 10-year minus the 1-month. And I audited banks when I was in public accounting. That was back in the 1980s and 1990s. I believe this is a better signal, even though most folks don't talk about it. I think the 10-year minus the 1-month is a better signal. And look at this. I think it's still in an uptrend. It's been rough the last month or two, maybe last 3 even, because what the Fed's been doing. Obviously, the 1 month, because it tracks the Fed funds rate much closer, has been going up a lot. And so it's been narrowing the spread. But the spread is still very, very significant. I think this still means banks can make a lot of money. So this is telling me banks probably getting cheap with this drop. And we're starting to turn back toward positive correlation. And I wouldn't be surprised if the Fed puts on the brakes that we see the 1 month Treasury halt and maybe even start to drop again. And that would increase this down the road, which I think in turn will provide a pretty good backdrop for banks. All right, not a whole lot going on with earnings. I'm going to skip over earnings, not much coming out this week. I'm just going to jump into the 3 you must see. The market just opened a minute ago, so I want to wrap this up. Etsy, this is one of the charts that's starting to get me really excited. We got these bottoms in here. Look at that AD line starting to turn up. Went right through the 50-day like I wasn't even there. Volume was picking up. Starting to see a little bit of relative strength here, about a 6-week high. These are the types of stocks, when they start rolling, start to get me more excited about the market. So that's Etsy. Next up, Paycom, PAYC, another one. You know, we got this double bottom in, made a move through the 50, came back down, put it in a higher low, and now broke out above this prior move here. So I think Paycom's starting to maybe turn. Look at that AD line moving to about a 3-month high. Things are starting to look a little bit better here. Look at the relative strength on Paycom moving to about a 6-month high relative to software. Starting, I mean, this was a stock that was 550, went all the way down to 260, 255. Now starting to make a turn back to the upside. I think it's starting to look a lot better. And then Micron just reported earnings, and we saw it going down. But look at these recoveries late in the day. Back, this would have been last Friday, or no, this would have been, Friday and Thursday of last week. And then yesterday we came roaring back, another big hollow candle. We're trying to go higher again today. Semiconductors have been beaten up so badly. I'll admit I actually have a little piece of the SOXL, which is a 3 times the semiconductors, just because they've been beaten up so badly. But I like this move here on Micron. If I just go to a regular chart, on this lower low, look at Micron putting in a positive divergence. So I wouldn't be surprised to see the semis make a little bit of a move here. And just looking at the semis, look how badly beaten down they are. They don't have a positive divergence though. So maybe it just pops to the 20-day, but that would be probably 5, 6, 7%. So I think this is a group that could do pretty well here in the near term. All right, let's see what's going on in the market. We'll wrap up for today. Appreciate all of you tuning in. Well, we do have the market up, so the futures didn't last in the red very long. You can see S&P 500, Etsy right up there, #1 again, continuing to push higher. That's nice. Dow right now up 100, S&P up 16, NASDAQ now up 51. I believe the S&P was struggling to get back through 3830. Let's take a look at that real quick. Yeah, right in here, these last several days, we had been struggling to get through 3830. So we finally made that on an hourly chart. Yeah, right in here. So I think this could lead us back up to test that June 28th high, closer to 3950, and a break above that. Well, you can see there's the reaction high at 3950. Here's a reaction high at 3950. Move through 3950 would start to get very exciting on the S&P 500 on the hourly chart. And then of course that would also put us above the above the 20 and heading for the 50 at that point. So I think things are looking pretty good for the market short term. Like I said yesterday, even though futures were down in my show yesterday, I said I'm sticking with my bottoming call. I'm sticking with my bottoming call. I'm just seeing too many signs that suggest we're going higher. Anyway, that's it for me. Everybody have a great day. I'll see you tomorrow, hopefully, over at Stock Charts TV, 9 a.m. It's a recorded version I'll be doing later tonight or tomorrow morning, but it'll air at 9 a.m. tomorrow morning. So check that out. I'll be right back here at EarningsBeats on Thursday morning for your next live episode of Trading Places. Hope to see you then, everybody. Happy trading.